Here are 5 strategic decisions to consider for 2026 when it comes to retirement plans, Medicare, and Social Security. First, your IRA versus your Roth IRA deferral split. Second, does the $8,000 new catch-up for 2026 apply to you? Third, if you're between the ages of 60 and 63, are you taking advantage of the super catch-up? Fourth, the phase-out limits for the IRA and Roth IRA contributions for 2026. And fifth, the differences and upcoming changes to Medicare and IRMAA. If these steps do apply to your plan, and you miss one, you could end up seeing your Medicare premiums creep up. For 2026, first and foremost, here's what's on the table. Your contribution limits for your employer retirement plans have now increased up to $24,500 for the year. If you're age 50 and over, you can now contribute an additional $8,000 as a catch-up to your employer-sponsored plan. Or, if you're between the ages of 60 and 63, you might consider taking advantage of the super catch-up, which for 2026 is $11,250. These amounts only pertain to the employee contributions made to the plan, completely separate from any employer match or discretionary contributions for the year. These standard limits generally apply to 401k plans, 403bs, and 457s. But a trade-off to be aware of is while deferring this extra pre-tax money in the immediate might give you a deduction and could feel really great, you might end up pushing that tax liability further down the road, which could have consequences of its own. And this could come in various ways, whether through RMDs or required minimum distributions, withdrawals over time to fund retirement, or any conversions that you might make between pre-tax money and moving it to Roth money. And the trick here is that Medicare takes into account your income looking back 2 years for Medicare premiums on Parts B and Part D. So, in theory, the further you end up pushing off that potential tax into the future, the more consequence it could end up being when taking into account Medicare premiums and even IRMAA. With that said, I will say time and time again, it's not just how much you're saving, but which buckets of money you're saving in over time. Now let's take a quick look at the super catch-up between ages 60 and 63, who it applies to, and what are the potential hurdles that you need to get past in order to make these contributions. As you may know, Secure Act 2.0 carved out a temporary age-based super contribution above and beyond the traditional $8,000 for 2026 that you can make. So, the 2026 total, if you are between the ages of 60 and 63, allow you to contribute not only the $24,500, but in addition, another $11,250 on the year, for a total of $35,750. In theory, this could help create a larger runway as you move into those later years of working closer to retirement, without having to rely strictly on market returns. There is, however, a potential pothole to be aware of here, as when it comes down to Secure Act 2.0 and a rule that was just implemented, the look back for your previous year's income level could determine whether that money is contributed on a pre-tax basis or a Roth basis. And that income number for 2026 is $150,000. What this means for you, if you fall into that category where you're making $150,000 or more at your current employer in which you're contributing to their employer-sponsored plan, any additional catch-up money must be steered towards the Roth bucket, and in turn will not receive a deduction from your income for the year. So, in a year that you're nearing that Medicare bracket edge, this could be more meaningful than if you were to get the deduction by itself. Consider this. 2 friends working at the same company. First is Dana, age 60, and she decides to take full advantage of the super catch-up that her plan offers. She actually sets it up on a per paycheck basis starting in January of that given year. She stays eligible for all 4 years between ages 60 and 63 and understands that making that contribution and having money go into the Roth bucket can help to potentially allow her to navigate easier as she nears Medicare age. By contrast, Michael turns 64 in November and does not qualify for the super catch-up. He decides to go the route of using the standard catch-up, as well as implementing IRA strategies outside of his 401k to try to increase and enhance his savings. In theory, he could potentially reach similar totals, but he does have to be aware of phase-outs and potential pro-rata rules when taking this into account. And the bottom line is, the situation between both Dana and Michael can end up echoing down the road when having to make choices that could impact your modified adjusted gross income, which is counted towards those Medicare premiums. A few variables to keep in mind here are the fact of the matter where you could end up receiving a potential bonus on the year, which could affect your income, Roth conversions, which could also notch up your modified adjusted gross income, or taking out potential deductions, which could also have a similar impact. So let's take a minute to look at that 2-year look back and how the decisions you make at age 63 could impact your premiums at age 65. When it comes down to how the system works, very basically, Part B has its own brackets that are based on different income levels, where Part D has potential surcharges. The system can be looked at as mechanical by nature, whereby the brackets in which Medicare Part B is based off of tend to adjust annually for inflation. In addition to that, you tack on the potential surcharges of Medicare Part D. But here's where things can sneak up on people. It typically might feel like a win when the adjustments as far as contribution limits each year are announced. But on the flip side, IRMAA can be very unforgiving. And if you cross the line by even $1, you could end up facing severe consequences. Say a married couple sits right below the IRMAA threshold for the year. Even just $1,000 added to their modified adjusted gross income, whether it be a bonus, part-time work, or even a slight Roth conversion, could end up tipping the scales. The result here is that each spouse could end up paying a higher premium for Medicare Part B, in addition to each of them being hit with surcharges as far as Medicare Part D is concerned. And the bottom line is that this can add up quickly over the course of the year. With that framework in place, the next lever to consider is your IRA strategy for the year and how you can support your IRMAA goals and vision as opposed to fighting them. For 2026, the income thresholds used to see whether you can contribute to an IRA or a Roth IRA have both increased. In 2026, the deductibility of an IRA contribution for single filers now phases out between the income levels of $81,000 and $91,000, provided you're covered by an employer-sponsored plan at work. For Roth IRAs, this income phase out is now between the income levels of $153,000 and $168,000. Those that are married filing jointly will also see those bands increase for 2026. In addition, spousal IRA contribution rules are still at play as well. And where I see higher earners trip up here is that they just assume based on their income that they can't take advantage of any type of IRA contribution or Roth IRA conversion. With wider ranges, you still might qualify for the ability to contribute directly to a Roth IRA, or even on a partial basis. In addition, as far as coverage is concerned, if things work in your favor, there might also still be deductibility with traditional IRA contributions. If you are covered by a plan through work, generally speaking, deductibility relies on your modified adjusted gross income when it comes to IRA contributions. On the other hand, if you're not covered by a plan through work, you might still get the deduction regardless of your level of income. And for those of you who are married filing jointly, where one spouse is working and one spouse is not, there is the ability, in theory, to make a spousal contribution to a retirement account on behalf of your spouse. And that follows a separate limit as far as modified adjusted gross income is concerned. This could open a path to deductibility for even higher income earners, even though they might have thought otherwise prior. Say a couple sits near the Roth phase-out ceiling limit, but still wants Roth contributions for the year, whether it be for flexibility as far as tax planning is concerned, or even navigating IRMAA down the road. They might consider adjusting their workplace 401k and moving a portion of the Roth into the pre-tax bucket to allow them to lower income just below the phase-out window. This small shift in strategy could end up allowing both spouses to make Roth contributions for the year, whereby the impact could be threefold. They're still able to save the same total, they could potentially navigate IRMAA with more flexibility down the road, and they skip the chaos that could come with backdoor Roth conversions. Now let's look at how these different levers can work together to see how you might be able to make the best and most informed decisions for your situation moving forward. Decision 1 is having an understanding of your pre-tax versus your Roth contribution split. Take a look at where IRMAA thresholds currently fall and where they could fall in the future, and then layer on your projected required minimum distributions. If your projected RMDs could end up pushing you into a higher modified adjusted gross income, whereby you could face IRMAA charges, it might make sense to turbocharge your Roth contributions now, despite the fact that you don't get the upfront deduction. On the flip side, if you're nearing Medicare age and your modified adjusted gross income is right at that level where you could face higher Part B premiums, it might make sense to push that down by turbocharging your pre-tax contributions, whereby you end up lowering your income for the year. Again, important to note, with the changes in the catch-up rules and understanding your modified adjusted gross income, you could end up pushing your catch-up contributions into the Roth bucket for the year. Decision 2 is if you're age 50 and over, to consider automating that catch-up contribution of $8,000 for the year. Some may decide to make this change first thing in January for the new year to avoid any type of end-of-year scramble. The next decision is for those of you between ages 60 and 63 and understanding the super catch-up. In addition to the limits, having an understanding of how your income could end up forcing those contributions into the Roth bucket and how this all potentially ties into IRMAA down the road. Decision 4, understanding the limits as far as contributions, deductibility, and income are concerned with regards to individual retirement accounts for 2026. When eligible, direct Roth IRA contributions could help you build up a tax-free bucket of money down the road. Or, on the other hand, if your income is too high, consider partial Roth conversions laddered out over time, as both of these strategies could help you control your income when it matters most, in addition to helping you potentially mitigate taxes that could come with required minimum distributions. Decision 5 is timing of income. Sometimes you might not have too much flexibility, but if you do, and planning can help, consider any situations where you might have restricted stock units or RSUs, the timing of bonuses over the course of time, and any type of Roth conversions. And if possible, at age 63 is on deck, consider trying to avoid any one-time large income hits. I've always felt personally that having a plan in place helps me make the most educated decisions going forward. And if you're planning for or nearing retirement, and you're getting worried hearing about all this talk about a stock market bubble, check out our next video here.